When it comes to helping employees and yourself save for retirement, small business owners have several options, with SEP IRAs and simple IRAs being two of the most popular. Both plans are attractive because of their relatively low administrative costs and ease of setup compared to 401k plans. However, while they share some similarities, SEP IRAs and simple IRAs differ significantly in terms of contribution rules, eligibility, flexibility, and employer obligations. Choosing the right plan can affect not only your business finances but also your employees' financial futures. Let's dive into the top 10 key differences between SEP IRAs and simple IRAs to help you make an informed decision. 1. Who can contribute? One major difference lies in who can contribute to the account. In a SEP IRA, only the employer contributes to the employee's retirement accounts. Employees are not allowed to make their own contributions. In contrast, a simple IRA allows both employers and employees to contribute. Employees can defer part of their salary, and employers must either match contributions or make a fixed contribution, making simple IRAs more participatory. 2. Contribution limits. Contribution limits vary significantly between the two. For a SEP IRA, the employer can contribute up to 25% of an employee's compensation, up to a maximum of $69,000 in 2024. Simple IRA employee deferrals, however, are capped at $16,000 for 2024, with an additional $3,500 catch-up contribution allowed for those 50 and older. Employer contributions to simple IRAs are generally much smaller, either matching employee contributions up to 3% of salary or contributing 2% of each eligible employee's salary. 3. Eligibility requirements. SEP IRAs generally require that employees be at least 21 years old, have worked for the employer in 3 of the last 5 years, and have earned at least $750 in 2024. Simple IRAs typically have simpler requirements. Employees must earn at least $5,000 in any 2 preceding years and expect to earn at least $5,000 in the current year. The lower threshold for simple IRAs can make them more accessible to part-time or newer employees. 4. Employer contributions. Mandatory or optional. In a SEP IRA, employer contributions are completely discretionary, meaning the employer can decide each year whether to contribute and how much. On the other hand, simple IRA employers are required to make contributions annually, either by matching employee salary deferrals up to 3% or by contributing 2% of salary for all eligible employees, whether or not they contribute themselves. 5. Administrative complexity. Both SEP and simple IRAs are relatively easy to administer compared to 401k plans, but SEP IRAs tend to be even simpler. SEP IRAs generally require less paperwork, no annual filings with the IRS, and fewer compliance obligations. Simple IRAs involve slightly more work, including employee notices each year regarding plan details and contributions, but still much less administration than a traditional retirement plan. 6. Flexibility for the business. For business owners seeking flexibility, SEP IRAs have a significant advantage. Because employer contributions are optional and can vary from year to year, businesses facing fluctuating profits may prefer the ability to contribute less, or nothing, in lean years. Simple IRAs, by contrast, require consistent annual contributions regardless of the business's financial condition, which can strain cash flow in tough years. 7. Vesting schedules. Both SEP IRAs and simple IRAs offer immediate vesting, meaning that once an employer makes a contribution to an employee's account, the money belongs to the employee without any waiting period. This is a great benefit for employees but could be a disadvantage for employers who are concerned about turnover shortly after making contributions. 8. Plan setup deadlines. The deadlines for setting up these plans differ slightly. A SEP IRA can be established as late as the due date, including extensions of the employer's tax return for the year the plan is intended to cover. Simple IRAs, however, must generally be set up by October 1st of the calendar year for which the plan is effective. If you want a retirement plan for a current tax year and missed the simple IRA deadline, a SEP IRA might be your only choice. 9. Withdrawal rules and penalties. Both plans carry early withdrawal penalties if funds are accessed before age 59 and a half, but simple IRAs come with an additional twist. If you withdraw within the first 2 years of participation, the penalty jumps to 25%. instead of the standard 10% early withdrawal penalty. SEP IRAs follow regular IRA withdrawal rules, which include a 10% early withdrawal penalty if taken before age 59 and a half, making SEP IRAs slightly less punitive for early withdrawals. 10. Suitability based on business type. SEP IRAs are often better suited for sole proprietors, partnerships, or businesses with few, or no, employees because employer contributions must be made equally to all eligible employees if any contributions are made. Simple IRAs are generally better for small businesses with a slightly larger workforce, especially when the owner wants employees to take an active role in contributing to their retirement savings and doesn't mind the mandatory employer contributions. While both SEP IRAs and simple IRAs offer valuable retirement savings options for small businesses, the best choice depends on your specific business needs, cash flow, and how involved you want employees to be in saving for their future. If you prioritize maximum flexibility and simplicity, a SEP IRA might be the right fit. If you're looking for a way to encourage employee participation in saving while committing to consistent contributions, a simple IRA could be more appropriate. Understanding the key differences in contribution limits, employer obligations, eligibility requirements, and administrative responsibilities can help you make an informed decision that supports both your business's financial health and your employees' futures.